Welcome to the Trading with Venus podcast, where we help you establish strong trading habits, generate consistent profits, and create the lifestyle you desire for yourself and your family. Now your host, Raman Gill.
Welcome to another episode of the Trading with Venus podcast. This is your host, Raman.
So today we will talk about carry trade and market correlations. So this is an important topic because things don't move just separately. There are a lot of correlations within the market, and it's important for us to understand that because that can lead us to some good trading opportunity based on these relationships. So before we get started here, though, just a quick disclaimer. This is for educational purposes only. Trading is a risky business, so please be careful with your money, especially during summer months when we have low liquidity in the market. What that means is that price can carry on or trade can go longer than expected. And also it can cause quick jumps, price moves, small orders can push the market around when they wouldn't be able to do that under normal market conditions. All right, so let's start by taking a look at interest rates. So when we talk about carry trade, it really is just the differential in interest rate. And interest rates, as we have seen currently, especially with the monetary policy changes here, interest rates play a big role in the value of the currency. So when interest rates are going down, then the currency will drop as well. And now, as we have seen, central banks are working towards tightening the monetary policy and raising interest rates. And as a result of that, the currency has strengthened. Our currencies are strengthening as well. So Fed has already done that. They've raised interest rates. So US dollar, we have seen over, not this week, but overall, US dollar has gained from that. And then now we are looking at Bank of England potentially raising rates. And ECB is also tightening the monetary policy. So as the interest rates go up, the currencies, the particular currency will go up as well. So that's a direct relationship between the two. So the reason the interest rates push the currency prices up is because when the interest rates are high, so let's say in US, let's say the interest rates have gone up. So now somebody could put their money into the bank in the US, and they can actually get a return on that. So as the interest rates go up, investors want to basically put money in that currency and get those interest rates. So what they will do is they will have to. So let's say somebody from outside of, let's say Canada has raised interest rates as well. So outside of Canada, somebody wants to invest money in Canada, or they want to just, let's say, leave money in their Canadian bank account. And I'm talking about these big corporations and not financial institutions, but bigger investors here. What they will do is they will go get millions and millions of dollars. So when somebody wants to invest in a particular country, you have to get the currency for that country, right? So if somebody were to buy, let's say, Canadian dollars, so they would have to buy Canadian dollar. And as they buy Canadian dollars, that will push the price of the currency up. And as a result, you will see a stronger Canadian dollar. So this is the relationship because it creates more demand. And as a result of that, the currency prices will go up. And that's why interest rates drive up currency price, because it increases the demand for that currency. Now, usually the different countries will have different interest rates. So Japan, for example, has had negative interest rates. So carry trade is when you buy one and you're selling another one. So it's the difference between the two interest rates. So let's say Japan is zero. We won't even go negative. It's negative right now, but let's say it was zero. And United States, you're paying 1.75, right? So there's that difference between the two currency. That's called the interest rate differential. Carry trade strategy is basically where you're selling a low yielding currency and you're buying high yielding currency. So carry trade is not done over a short period of time. This is over a longer period of time. So like I said, these are either big corporations or big institutions that are doing these carry trades, and big investors. Basically what they're doing is they're just doing this and just leaving the trade. They're not fiddling with it every week. They just leave it. And from time to time, we will see news about carry trade is they're basically undoing the carry trade, and then we'll start to see the flows in the opposite direction. But the carry trade strategy basically means you're selling the low yielding currency and you're buying the high yielding currency. So low yielding currency will be the one that pays low interest rates like Japanese yen, and then high yielding currency will be anything against that has higher interest rates. Normally we don't count US dollar as that, but now the US dollar has been going up. Before it used to be Australian dollar, Canadian dollar, New Zealand dollar, these kind of currencies. So now it can be any one of these. So you're just basically selling the low yielding currency and you're buying the high yielding currency with a higher interest rate. So let's take an example. For example, so let's say our high yielding currency, so right now the interest rates are not 3.5, but just so that we can see enough of a difference, because Australian dollar used to be a higher interest rate here. So let's say we go long Aussie yen. Yen is always they've had negative interest rate for so long, and Australian dollars will actually have a positive interest rate. So let's say Australian dollar 3.5 interest rate, Japanese yen 0 interest rate. So basically, if you were to sell yen, so let's say you have Japanese yen, a company that is multinational, does business in different countries, they have Japanese yen and they will sell Japanese yen to buy Australian dollars. Or what they can also do is they have branches in different countries, so they have relationships with different banks. So you can actually borrow money in Japanese yen, and then you are exchanging that for Australian dollars, and then you put that money in Australia. You just leave it in an account in Australia. So in that case, that investor would make a profit of 3.5. Because let's say they're borrowing money in Japanese yen, they're paying 0% interest rate, right? And then they go and put that, they're not even doing anything, they're not even taking any risk. All they did was borrow money in Japan, brought that, and then converted that to Australian dollar and just put it in the bank. And bank pays 3.5 interest rate, 3.5. So the quick profit is 3.5% without having to do anything. Now, if they take that and they leverage it up, and the leverage, let's say they're using 100-to-1 leverage, is a $10,000 account, and you could do a one standard lot or whatever the return is. Let's say leveraging it up, and actually you don't even have to do 100-to-1. This is actually wrong here. 100-to-1. This is not 100-to-1. This is just a 10-to-1. If you leverage it up 10-to-1, you're getting 35% return. So this is actually not correct here. But yeah, just leveraging it up 10 times, so you will get a 10 times return here. So you're getting a 35% return just by leveraging it up 10%. And if you were to leverage it up 100%, you get that sort of return, right? So this is where the carry trade can be really beneficial. And I used to do this particular trade a long time ago. I had a $10,000 account, and I would just leave it there, buy one standard lot and not do anything really, just kind of keep moving my stop as the price used to move up. So this used to be a really, really good carry trade, but this trade would still exist. And this is more of a longer term trade. You don't really fiddle with it, just kind of let it run. The concerns with the carry trade would be geopolitical stuff, economic situations, right? So economic conditions and growth prospects of the country. So right now, for example, Australia has really held on to their interest rates. They have not moved on them. So if the economic conditions change, then it could cause the central bank to drop the rates, right? So that is a concern. That could happen, and that would be a problem if, let's say, the economy is not doing well, the country is not growing, and that could cause the central bank to basically drop rates or lighten the monetary policy, which could cause a problem for the carry trade, because then the interest rate will be lower and the currency strength won't be there. What we're seeing right now, political and geopolitical risk. So when things are smooth, like they used to be back in the day, you didn't have to worry about too much geopolitical risk. These days, there is tons of geopolitical risk. The markets are more erratic. We see these crazy moves in one direction, then in another direction, that they don't really follow any kind of trend. So it's been a little bit more challenging from day to day, week to week. We see prices will turn around, whereas before, things will be a little bit more stable in the sense that you get on a trend and you could ride that trend for a longer period of time. Nowadays, one day it's a pin bar, a second day it's a bullish engulfing candle, right? So things have been a little bit more erratic than they used to be, but generally, and the reason for that is the geopolitical risk. Countries putting tariffs on each other and things like that, Brexit, EU negotiations, and these type of things are creating this political and geopolitical risk, which is fluctuating or making the currencies fluctuate. So that could be a problem. And the biggest concern with that to the carry trade is that when that happens, it's the Japanese yen is one of the safe haven currencies, right? And then Japanese yen will go up. So if you're going long Aussie yen and Japanese yen starts to strengthen, that trade will actually go down instead of going up. And it can fluctuate back and forth, just like we've been seeing. One day Japanese yen has been strong, another day it turns around and market makes things okay, right? So just with the tariffs as well, even though there was this big concern about tariffs, but looks like market is essentially ignoring the news and just kind of waiting to see what happens. So market participants seem to be on edge, and there's this wait and see on one hand, and then there gets to be a quick reaction on the other hand. So right now, this is geopolitical risk. So this is a good example of that. So, and this strategy is a good strategy for somebody who just has some money and they don't want to take too much risk and they just want to let it go. So this is set and forget type of strategy where you're not interfering with the trade. You're just basically borrowing money in one and you're selling in another. So that's all there is, and you can actually, you're making interest off of that. So you're still holding the currency. You haven't really done anything. You're actually holding physical assets, and you don't have to leverage it up, right? And the bigger institutions and stuff would not leverage it up 100 to 1. There's no way. They may do 5 to 1, for example, right? But even with that, they can get good return on their money, whereas the money may just be sitting in the bank. This way, they actually get a good return, better than what they would if they were to just, let's say, had the money and held it in a Japanese bank. So this is a way to increase the return you're getting without increasing the risk. And when there's economic crisis, like we saw with Brexit and stuff like that, investors become conservative and they choose to go to a cash position, right? When they tend to do that, they will take money out of risky investments. So Japanese yen is, like I said, safe haven currencies. They will take, investors will cash in their, let's say, stock market positions. They will liquidate part of their stock portfolio, and then they may just decide to hold that in cash, or they may buy Japanese yen because Japanese yen is considered to be safe haven currency. So that can jeopardize the Aussie yen trade or the carry trade, because now instead of selling the yen, everybody's buying yen. So that's another risk. So so this type of geopolitical stuff, as well as like economic things, can create a risk for the carry trade. And also during economic crisis. So now we are seeing monetary policy changing where interest rates are going up. And after the financial crash back in 2010, 2011, 2012, so interest rates were going the other direction. So we have quantitative easing 1, quantitative easing 2, that US did, and as a result of that, US dollar was just going down. It was just getting hit because they kept decreasing the interest rates in order to stimulate the economy, and many countries did that. So during those times, this carry trade will not work because it will bring the interest rates going down, will bring the value of the currency down as well. So this is why when things are uncertain and investors are panicking, this is why Japanese yen will actually go up. So during geopolitical risk time, like right now, this carry trade would not be a good trade, but once things settle down, carry trades are one of the trades that every single large institutional trader will do. This is one trade that everybody will take. So it's important for us to understand that, because when it unwinds, and there will be periods where this carry trade will unwind, you will hear in the news, carry trade is unwinding. That means they're doing the opposite of that. Instead of buying Aussie yen, they're selling Aussie yen or something like that, right? So this is why it's important for us to understand from that perspective, so that we are more aware of what's going on in our environment. And if the institutional traders are doing it, doesn't mean we have to do it, but we have to be aware of it, because when they are unwinding the carry trade, or when they're going into the carry trade, it will have real market implications for us. All right, so carry trade, basically, just to summarize things here, carry trade is based on interest rate differential. So it means, for example, Aussie may have, or right now it has 1.75 is the interest rate. So right now the interest rate is higher in Australian dollar versus Japanese yen, which is zero, still zero, negative. So you're basically betting on the differential in interest rate, and you're finding something that has a high interest rate, like Aussie, and you're selling it against a currency that has a low interest rate, like Japanese yen. And once the trend is stable, this works best when the trend is stable. You're basically buying high-yielding currency and selling a low-yielding currency. So you just need to find two currencies, one with higher interest rate and one with lower interest rates. And this is how this carry trade works. So even if you're not borrowing money from one country to another, in your own account, you can just take a long trade and you just leave it there, and you set your stop so that the fluctuations don't matter as much. You just kind of set and forget. And over the long term, the trade will play out. Okay, so another topic which is sort of related but not exactly related is the market correlations. We have talked about this, but not everybody may have listened to that webinar, so I thought I will quickly go over this as well. Market correlations is basically how the different things in the market are interrelated, different assets are interrelated. So in this case, what we have here is we see gold, oil, the dollar, they're all interrelated. So let's take a look at the different relationships. So positive correlation is when two securities move in the same direction. For example, when we see oil go up, Canadian dollar tends to go up. And when we see gold go up, we also see Australian dollar go up. So those are positive correlations where both of them move in the same direction, and that's called positive correlation. Now, negative or inverse correlation is when one moves in one direction and the other one moves in the opposite direction. So they are inversely correlated or negatively correlated. So if you see those terms around, then that's what it means. An example of that would be US dollar and gold. They have inverse correlation. So when US dollar goes down, gold will go up, and vice versa. So that's an inverse relationship, oil and US dollar as well, because oil is priced in US dollars. So that's an inverse relationship there as well. So that's called inverse correlation there. So if we take a look at this chart, this is only till 2000, but this kind of shows the point. So as we see, as the price of gold goes up, Australian dollar tends to go up as well. So it's not like perfect one-to-one where dollar for dollar relationship, but it tends to move in the same direction. Now, there will be times from time to time where it could be slightly broken, but overall, this relationship tends to hold. So gold and Australian dollar are correlated. And the reason for that is because Australia is a producer of gold, and they sell gold, and they sell natural resources. So as a result of that, commodities are important for Australia, and they're a big exporter. So as the price of gold goes up, they make more money, and as a result of that, there's this relationship that exists. Same thing with Canada as well. Canada is a big exporter of oil. As a result of that, as price of oil goes up, we have seen Canadian dollar go up as well. That means dollar CAD will go down. So that's the relationship between oil and dollar CAD. So in this graph, we can see as oil was going up, Canadian dollar CAD was going down because Canadian dollar was strengthening, which means dollar CAD will weaken. So because Canadian dollar is in the second place here, so that's why we would look for it to come down. So this was coming down. So there is this, there can be times, like I said, when that relationship gets broken, and that could happen for different reasons. And actually this one is, the reason here it broke was because of the financial crash in 2008, 2009. But generally this relationship tends to hold unless, of course, there is financial crisis and things like that. But in our day-to-day, oil goes up, dollar CAD goes down. So that's a direct relationship. So this is just some examples here. As we can see, oil and US dollar here, dollar CAD, we see dollar CAD will drop. I'm not sure if I have the oil chart here. No. Okay. But so basically when we can go to our charts, and actually let's go to our charts, take a quick look here. So we have, actually I'm looking for dollar CAD. So dollar CAD has been coming down. So let's take a look at oil. So oil has been coming down in the last couple of days, but it was going up all this time. And right now there's data and stuff that will of course impact Canadian dollar and the currencies here. But generally, as oil goes up, dollar CAD should go up. So where's my dollar CAD? Sorry. So we saw the oil prices going up there, and dollar CAD tends to go with this as well. Now, do keep in mind this will be impacted by the US dollar as well. So it's not a one-to-one, completely perfect relationship. But generally, if oil is going up, dollar CAD will drop. Sorry, not go up, sorry, drop. Here, so this is why dollar CAD was dropping, and when the oil was coming down, dollar CAD didn't really do very much here. All right, so that's all I have. So we'll call it a wrap.
Hope you enjoyed this show. For show notes for this episode, please visit tradingwithvenus.com episodes page. That's it for today, and I'll see you next time.
If you want consistency in your trading, we invite you to join our daily market analysis calls, where we provide the levels to find the best entries and targets on an intraday basis. For a 1-week free trial, please visit www.tradingwithvenus.com. Thanks for joining us today. With much gratitude, your show host, Raman Gill.